a very interesting question, and I think the way to currently think about the global economy and in context of where we are today, I think it seems to be sort of a Goldilocks period as far as India is concerned, where most of the advanced economies are sort of facing recessionary kind of environment, or there are signs of slowdown. For example, China is experiencing deceleration in their demand, in their economic growth. Similarly, US also has seen some kind of deceleration in their GDP growth. So I would say that the world is sort of grappling with these issues because of the tighter monetary policies in the past, higher inflation of the past. Maybe uh, they are towards the bottom right now, and maybe the next 1 or 2 years could be better. But interestingly, at this point in time, when the world is sort of growing at 2-3%, India is relatively well placed in terms of the growth metrics. We are sort of looking at, let's say, 6-7% kind of growth. And the good part is that we are sort of, the growth is more internal to us. The growth is more domestic driven. It is more linked to the structural changes which are happening in India, linked to, let's say, urbanization, digitization, um, rising income. So I think all of these cumulatively is sort of providing a more sustainable uh, growth matrix as far as India is concerned. And hence, from that perspective, the outlook remains relatively much better. However, also sort of let me just add one small point. Uh, we've actually experienced in the past that if India has to move up from this range of 5-6%, which it can potentially, the world growth has to be supportive. So if the world actually slows down, it has its own bearing on the global trade. It has its own bearing on our export led industries, and typically in our current pool of revenue or profits, we almost have about 30-35% exposed to the international market. So while we can relatively do well in terms of the overall growth driven by the domestic economy. So I think it is just linked to what I mentioned as a part of your previous query. I would say that India has been doing right things post COVID. We saw that the government has substantially raised their level of capital spends in the economy, which was, I think, very critical at that point in time. Beyond that, the structural growth pillars, few of which I mentioned about demographics, income levels, urbanization, digitization, all of those are sort of helping our growth metrics. More importantly, I think when we look at the country's balance sheet, we are actually in a good position, I can say. The government is definitely thinking about containing the fiscal deficit, and irrespective of the fact that they have raised their capital spends. I think that is a good spot to be in, where you are sort of trying to maintain your fiscal deficit and also have good spends, in terms of the capital expenditure. Now, I think interestingly, again, if we look at some data points, let's say the GST run rate, which has been 1.5 lakh crore and above on a monthly basis, that is suggesting that the activity level in India has improved. The more businesses are getting organized and coming into the compliance of the taxation, and which is where we are seeing the momentum in the income levels for the government, which is actually helping the government not only in maintaining their level of spends, but also sort of thinking about having a controlled fiscal deficit. So I think that is something very important from India's perspective. The third important aspect is, when we look at the our external accounts, when we look at our current account deficit, I think we are pretty much under control at 1.5%, which is again a good point, irrespective of the fact that the trade deficit tends to be higher. I think it is to do with the services income, which is actually doing extremely well. So I think that is again sort of a good position to be in terms of the external account, which actually lends strength to the rupee. And we have seen that the currency depreciation of late has not been as severe as it used to be, let's say, a decade back. So I think these are positive signals for our economy. Beyond that, yeah, I would say that the forex reserves is also pretty sound and solid. All these things lends a lot of confidence to the investor community, both domestic and especially the international investor, when they are looking at a combination of good growth, sound balance sheet, good capital efficiency for the country, and sustainability of growth. I think those are the good metrics which is driving the momentum which we are seeing in the markets today. There's no real correction which we have seen, and I think the volatility is at the lowest point today. But I think that is to do with some bit of these fundamental factors, and also added to that is maybe a combination of euphoria, which we are seeing in the markets today. Everyone is sort of wanting to participate in this India growth story. We have seen a lot of domestic flow of capital, which is chasing the equities, and which is where we are seeing that while the fundamentals have clearly improved, but it has got coupled with very strong positive sentiments, and that has also led to huge amount of flows. Now, previously we had seen that FI flows used to have a good amount of volatility as far as the markets are concerned. But in the last 1 or 2 years, despite the volatile flow of the foreign investors, we have not seen equal amount of volatility in the markets, because it has got compensated by virtue of the domestic flows. So I would say that there is this financialization of the savings which is taking place. More and more investors are tapping the equity markets for generating maybe better returns than what fixed deposit can provide. And hence that euphoria is there definitely as a part of the equity markets today. So from the investors perspective, I would say that the long term outlook of India is strong. The equity returns over the next decade or so should sort of not disappoint, is my sense, given the growth metrics what we are looking at. But at every juncture, one has to slow down and evaluate where exactly are we in the valuation curve, because it is not that these good times can keep sustaining, and the linearity of the curve cannot remain for long. So not that I'm predicting sharp corrections, but what I'm saying is that the investors need to be mindful of their expectations at this juncture, when the valuations have reached sort of a peak point, and especially few categories like small mid caps, which have actually seen lifetime high kind of valuations. I think the expectations need to be moderated. Investors need to be more cautious around how they are investing, and also the behaviors need to be sort of under control, and not trying to chase all types of businesses, because eventually what is going to matter and what is going to be determining the eventual outcome is going to be the quality of business, at what rate has the earnings grown, and that is what the returns are going to be sort of tracking over long periods of time. So I think the core fundamental thought process has to be kept in mind by the investors, and maybe reassess the asset allocation and try to be more disciplined around how they want to look at their asset allocations. Whichever cuts we would like to look at the valuations. Valuations are near their maybe lifetime highs when it comes to the mid caps and small caps. And as I said, backed by sound fundamental changes which have happened, growth metrics for the organized companies have become better. Capital efficiency measured in terms of ROCs have improved. Companies have consolidated their leadership market shares, and I think all these things have played well. When we look at a large segment of the mid caps and small caps, I would say that there are still good set of companies which can keep growing at I would say decent run rate and keep outperforming the broader market when it comes to earnings growth. And I think these companies will eventually drive the returns from the investors' perspective. But as I said, that one should not take away the eye from the valuations. And at levels where we are today, I think it only calls for being slightly more cautious in terms of the expectations. Not that the category will not give sound returns over long period of time, but just that investors need to realign their time horizons and maybe be prepared for holding on to these companies for the next 5-7 years, or their funds for the next 5-7 years. I think that is the way to solve for high valuations today, or maybe use the systematic way of investing to try to tackle the high valuation, so that in the journey, if the markets were to become volatile and one has to average out their buying, the SIP route becomes a advisable route. So I would say that's how one can think of tackling the valuations. But fundamentally, I would not want to create any kind of caution. Fundamentally, we are in the right track and companies are sort of doing well. So I think again, there can't be one answer, because all investors have different profiles of income levels, their own risk profiles, or their own objectives. So I think for each investors, the answer needs to be more customized. But on the whole, if I have to sort of guide, I would say that looking at where we are in the market cycle today, just maybe temper down the return expectation. That is number one point as far as the investors are concerned. Just from the optics of valuation, the large caps are relatively well placed versus the mid caps and small caps. And hence, from that perspective, maybe a slightly more allocation to large cap is making more sense in the current juncture. So maybe investors can look at that as a possibility. The other thing is that investors who still want to capture the mid and small side of the opportunity, I think nothing wrong, but just in this category, one needs to have a higher time horizon, and or one needs to sort of try and build exposure into this category via systematic investment route. So I think I would say that instead of deviating significantly from the asset allocation, maybe just trying to be slightly more smarter around how to invest can create a better outcome, or optimum outcome is what I feel. I mean, what I try and do is that just try to relax the mind, and I think meditation is a good way. Trying to learn that. That is incrementally, I'm finding it very powerful tool to unwind and maybe relax. But I would say that maybe if I can quickly learn to inspire people around me, create a positive environment, build, give motivation to people around me. So I think both in your personal and the professional life, which is our professional life is linked to the market. I think what Warren Buffett has said, that be fearful when one is greedy and be greedy when one is fearful. I think that is very important because it works even in your personal lives. When some things are going in excess, you need to sort of rewind, look at that situation, and maybe if it warrants a change, you need to change.